In this week's update, what do us Aussie investors do given our dire position? Markets building for some big moves, currencies, commodities and stocks, and bullish momentum in many pockets of the market. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Let's start by looking at some realities, because I think there's a good chance that we've seen a significant pivot point in markets, and I'll get to that in coming slides. But market lows occur when the news is worst. I think a lot of people understand that intuitively. It's just hard to respond to it because it fights with everything that is in our subconscious. So it's not an easy thing to recognise and acknowledge. But I certainly think there is plenty of evidence that we've reached that pivot point, and some sectors didn't ever get affected by what is happening with oil and in the Middle East. So they've just sailed on regardless. And the bigger the event, the more illogical it seems at the extremes. And I know it seems completely illogical to a lot of people in the last month that stock markets just wouldn't absolutely fall over and that the world as we know it is going to crash and burn. But so far it hasn't, and it almost certainly won't, because things change and we learn to adapt. But today's news, this is the reality of it, that today's news was priced in weeks or months ago. So you've got to get used to that fact. And tomorrow's news is getting priced in today. And that's the most important thing. And that's why observing money flows is just such a key part of successful investing. The price action really is what should dominate your actions, not necessarily the base research, because you've got to make sure that you get yourself in the right fishing hole by doing the right fundamental analysis. But once you've done that and you've identified opportunities that are going to be lasting for the long term, then you use money flows and contrarian awareness to time your entries and your profit taking. And contrarian awareness is absolutely vital, because markets turn at the extremes of emotion, extremes of price action. So it's a very valuable skill to take on board. You simply need to just shut out the noise and observe and respond. And you've heard me say that before. Members that have watched this video for years and years know that that's one of my key mantras. Observe what the market is doing, keep an open mind, and then respond to it with appropriate risk management. And risk management is absolutely everything, because you've got to assume that absolutely nothing is guaranteed, no matter how good it looks or how assured it looks. Things can always change, things can always go wrong, because anticipating the future requires assumptions to be made, and those assumptions can always be in error. So managing risk, which when you really understand how to do it, is as simple as falling off a chair. It really is. If you've not been in the market for very long and exposed to the ups and downs, then you might find risk management confusing, but it really is a very, very simple process. It's just a matter of changing your thinking a little bit, how you think about the market. As far as Australia goes, and I produced quite a lot of content and factual opinion or factually based opinion last week, but our true position in the world has now come into absolutely stark focus. And it's just taken a few weeks to realise how vulnerable we are. Now, I said an absolute stack about that last week, so I'm not going to repeat it. But the absurd direction in which we're heading in numerous areas, and the absolute rank stupidity that's being sprouted by our political class, has been there for decades. It's been building for a long period of time, but as I said last week, our complacency and a whole bunch of other things have really just allowed it to continue to grow and get worse. And our political class, really, when you stand back and look at it, really has only one interest, and that's being in power. And it doesn't matter that policy in the short term, in the next electoral term, It's only a coincidence if that happens to do something positive for the country. And I couldn't believe a few days ago when one of the government's most senior ministers was posed a question about the development of oil reserves in Australia, and his comment was, well, we can't do that. It would take a decade or more. And I just shook my head and I was absolutely dumbfounded. And that's the problem that we face as a country. Other countries such as China and Japan think in decades. They think and they plan in decades. We don't seem to be able to think beyond the next electoral term. And that's why we are in the situation that we are in. And frankly, I don't know what the solution is. So what do investors do? The most important thing for people listening to this video is, what do you do as investors? Something that I do quite regularly, at least once a month, and at periods like this, once a week. I just basically try and abandon everything that I think that I know about the market. I abandon thought about what stocks that I own, and I just sit down and do this exercise, most of it just in my mind, and take a fresh canvas to what you're doing, just so that you can refresh your perspective. And it's a very simple process. It doesn't take very long. To me, there's only two main questions. What sort of return do you want from the market, average over the long term? And what is your tolerance to volatility? There's a few other things. How many stocks or ETFs do you want to manage? But they're essentially the two key things. What do you want and what can you tolerate from the market? Because that sets the framework for everything that goes into a coherent plan that can lead you to creating wealth way beyond what everybody else is doing. Now, practically, what does that look like? Well, you define the narrow field of seemingly immune targets, which is something that I've started talking about in recent weeks with this event in the Middle East, which has really exposed just how vulnerable we are. And to think that the impacts of what's happening in the Middle East are already obvious and on the table, well, you better think again, because this is going to flow right through the economy for a long period of time. There's a lot more consequences to come out of this. And so that's changed my thinking. This was one of my refreshes to change my thinking to really only be focused on targets that are essentially immune from the bigger picture environment that we can't control. You know, we can't control what happens to energy supply around the world. We can't control what is happening with AI and the disruption that it will bring to some industries and many, many stocks, but not all. So we can't control those things, but what we can control is being exposed to stocks that are largely immune. Now, in the short term, prices go up and down because of emotion. So in the very short term, even the immune stocks can still be impacted to a degree, but they'll bounce back very quickly because the smart money will recognise that they're immune from these factors overseas that are outside our control. So doing fundamental analysis gets us to the right fishing hole. It's the way that I think about it. And then I take that one step further and I go and find what I regard as the best of the best in each category, whether it be precious metals, whether it be software, whether it be medical technology, whatever it is, I just focus on getting the best of the best in each category. And you've got to ask yourself, why would you do otherwise? Why would you want to have a well-balanced portfolio, a bit of this, bit of that, some good, some bad, some ugly, some also-rans? I just don't understand that thinking. Why would you not want to own the best of the best in each category? There is only one reason, and that's that you don't know how to do it. But that is easily solved. And then once you've got to the right fishing hole and you've got your immune targets identified, the stocks that really aren't going to be impacted over the medium to longer term by factors outside of our control, then it just gets down to risk management, portfolio management, and that is driven by the money flows and the chart patterns. Hopefully, listeners can see how that all connects. It's just a sequential order of thought. There's nothing mystical about achieving well above average returns in the market. It's just how you think about it. And clearing your mind and doing a refresh once a week or once a month that takes a few minutes is just a great thing to do. Shut out the noise from the media because it's a complete waste of time. It doesn't add any value. In fact, it adds negative value because it puts thoughts in your mind. Unless you've got a really open, well-balanced mind, then it plants thoughts in there that just take you down the wrong track. And then just be patient and disciplined. There is nothing that is onerous or difficult or magical about successful investing. It is just about orderly and clear thought. And of course, that all feeds into, before you embark on this journey, you need to have all of your due diligence done in advance with respect to legal, structural, financial advice. Because these are dangerous markets these days, and I really can't see how that is going to change in the future. Geopolitical tensions are not going to go back to some really calm, orderly situation. Not for decades and decades anyway. Let's look at American stocks. The S&P, amazingly, with what's going on, up 3.55% for the week, and the Nasdaq added, getting up towards 5%. So a terrific week in the US. The Russell 2000, small caps not to be left out, was up nearly 4%. So last week I posed the question, which I've pinched from a well-known television show on Sport, is the bounce real or overreaction? And it's pretty clear that Wall Street says that it's real because there are so many stocks that are rising. And I showed you a couple last week, and in my regular review and refresh over the weekend, that has certainly intensified. There are more stocks that are heading up very, very strongly than there are going the other way. So Wall Street is betting with its wallet and says that it's real. There are many others who are saying that it's crazy. And in my view, that's absolutely fine, and that's what makes a market. And those people are saying it's crazy because they're assigning too much weight to fundamental logic. And fundamental logic doesn't work at the extreme for reasons that are pretty obvious. It's just human nature playing out. So I'm not too worried. In fact, I'm actually encouraged by all the people that are saying that it's crazy, that this shouldn't happen. Because you don't get lows in the market or in a stock or in any sector unless the majority of people are saying, this is crazy, this can't happen. So you actually want to cheer that on, not blindly, but if you've done your homework and you've got a really, really good stock that is immune from what's happening and it's starting to go up, then you probably want to believe it. I'm also continuing to see plenty of evidence on an intraday basis that pros are buying the intraday panic. We're seeing gaps lower on the open, and then we're seeing progressive buying for the rest of the session and a lot of stocks closing on their high of the session. That's the footprint of professional investors who are hoovering up the stocks being thrown out irrationally by people who are just reacting to the headlines. US dollar index came back off 100, and it's still sitting in this very pivotal zone between 96 and 100, finished at 98.7. And I get the sense that there's going to be a very significant breakout at some point. It's not just going to sit here. Now, logic would dictate that it should go down. The overall big picture direction is still down, but I'm open-minded enough, if this war continues for a long period of time, that the US dollar could in fact go up, which would keep a bit of medium-term pressure on commodities. 10-year yield was pretty much unchanged, 4.34, but the index continues to come down. So 2 weeks ago we were at 30, last week we were at 21, 22, now we're down to 19. So let's go and look at some charts. We'll start with the Nasdaq. I've put this on a weekly chart initially because we've had two very, very concerted weeks to the downside. And then we've had two even bigger weeks bouncing back up to the upside. This is the pivot. This was obviously a short week with Easter, but for a full week in America, that's pretty emphatic. Doesn't guarantee anything, and certainly underneath the index, there's quite a lot of divergence, with software now getting absolutely slaughtered again on renewed fears about AI disruption. Let's just put it on a daily, and you can see plenty of gaps went into Wednesday and Thursday's session. So overall, this is looking very positive. The 200-day moving average, the red line, is still up. The blue had started to curl over, but it hasn't crossed the 200-day yet, and the price is above both of them. So it's probably not an issue the way the market is heading at the moment. This is a key spread that I watch, which is consumer discretionary versus consumer staples. We seem to have found a point of stability, and money is definitely flowing back into some parts of consumer discretionary, and really strongly. If you can recall the couple of charts that I showed last week of ROST and also CASY. This is a chart that I think really spells it out. This is the semiconductor index or semiconductor ETF on a weekly chart. That's just one heck of a powerful week, broken out to new all-time highs. It's pretty hard for the market to be off the rails when semiconductors are doing that, and so they should. I mean, this demand for semiconductors is absolutely real. If we look at it on a sector basis, energy obviously came off with the oil price, but I certainly see energy in this current environment as a pretty useful hedge. So I've had a couple of questions from people about selling out of their exposure to energy. Not in Australia, I'm not at all keen on energy in Australia, but certainly in America I am, because it's just a completely different environment in America. So I see this as a pretty useful hedge to the ongoing disruption in the Middle East. And in Australia, not so much downside just in the last week in energy, but then again, it hadn't gone up as much as in the US either. Finance doing well, basically back to all-time highs, and materials just kind of snuggled there in the middle between the index. But the reality of looking at this chart, I put it up because I know some people like to see it. But to me, it's really meaningless because the index is just going to do what these two are doing here, finance and materials. And that's only 10 or 12 stocks. Doesn't really tell you very much about where the real opportunity set is. This is the S&P, looking very much like the NASDAQ. And I guess the other thing to notice here is just how close it is to the all-time highs. I mean, that's quite extraordinary. The all-time highs, just under 7,000. And we closed the week at a bit over 6,800. So we've only got about 150 points from the all-time highs in the middle of a war, which has more unknowns than I've ever seen. So it just goes to show that you have to watch what the market is doing, not what it should be doing. And there's the Russell 2000, so small caps and medium caps not being left out whatsoever in the US market. So that's our position. With Australia, the dollar went up a little bit, just a tick over 70. It should rise because the US dollar should fall, but I'm not betting on that at all. To me, currencies are outside my control, so I just don't worry about it. I just pretty much ignore it. The Australian index was up 4.4% for the week, but what does that really mean? Who owns the index? I guess if you're in some kind of passive low-risk fund, you kind of own the index. I guess it has some importance to you. But for me, the index being up 4.4% tells me absolutely nothing about what my portfolio did, because my portfolio is quite different. In fact, I don't own any of the top 20 stocks in Australia. So did we have a good week or not? I know I certainly did. And I know a lot of members did, because a lot of the stocks that were in rebounded very strongly. But I just pose the thought, is the herd getting exhausted by all this market up and down, flipping day by day on headlines? It gets really wearing after a while, and I've seen this so many times before when we get into these very volatile periods. It just seems to peter out. The sharp moves up and down. People just get sick of it. They're over it. But I get the sense that the herd is getting a bit exhausted by trying to respond to all these headlines. So from my perspective, I'm just doing what I've been talking about for the last 3 weeks or so, once it became evident just how vulnerable Australia is. I kind of knew that we had all sorts of problems in our direction in policy. It was going absolutely in the wrong direction in a number of areas, but I didn't realise just how exposed we were to global supply chains. An event like that really shines the light on it. I'm basically not buying anything at all that is not essentially immune from things that I can't research and control. And then once you've identified those groups, then you accumulate progressively. Don't make big moves, but just accumulate progressively on pessimism, on sell-off days, but also particularly on confirmed shifts in the money flow. If a stock price is tracking down, don't try and guess the bottom. Wait until the market shows you that it's turned and it's turned up. And if you don't know how to read charts, then you either better get good at it or you better align yourself with someone who is, because this is absolutely your key to investing success. Turning now to precious metals, gold was up 1.5% for the week, so a bit of a quieter week compared to some that we've seen, 47.52 in Australian dollars, not a lot of movement. The Australian dollar went up slightly, so that pulled the Australian dollar gold price down about $40 or $50. Silver added 4%, so still outperforming or underperforming, depending on the direction. So we're sitting around 76. Now, when we look at actually gold stocks, GDX listed on the Australian market over the last couple of weeks from the low point is up 13%. So that's been a pretty strong rebound. So that's a very significant recovery over just a 2-week period. But there are risks, and I've talked about these over the last few weeks, and gold producers and advanced gold developers to varying degrees and widely to varying degrees are exposed to the fuel situation, both the cost and the availability, because if you're running an open pit mine with lots of haulage and no hedging to fuel costs, then you're a lot more exposed to someone who's got hedging and has got an underground mine which is less diesel intensive. And it's a very, very large difference. And we're going to start to see that play out over the next 6 months as the quarterly and half-yearly reports come through. So you need to have an understanding of what it is that you own. It's not just good enough anymore to simply be thinking, well, I've got exposure to gold and silver producers. It's just not that simple. So we've got to find where the best reward for risk is, and there are some absolute standouts at the moment. And for those wanting to take on board a bit more volatility, a bit more risk, some of the advanced developers that have been absolutely pummeled are now looking extremely good buying. Before we move on to other commodities, let's just go and look at the precious metals prices. Start with silver on a daily chart, just to get a bit of a bigger picture view. Let's look at it on a weekly. So it's been a very sharp rise to the upside and then equally down. A, B, C correction to the downside, big picture. And now we're starting to rebound. But look, it's still a little bit hesitant. You can see this, we've got long tails, top and bottom. So that's indicating that the market is, in terms of the buyers and the sellers, the market is somewhat in balance at this point in time. It needs something to kick it over the edge. I'll just put that back on a daily chart. And you can see the candle ranges on a daily basis. They're getting smaller. You know, we don't have these really long peak to trough days. They're getting smaller. We've got wicks top and bottom almost every day. So this is a market that's very much in balance and undecided. This is gold on a daily basis. And if we look at that also weekly, you can see it's quite a different pattern to the silver price. It's a little harder to read for me because the silver chart has just got so much more volatility than this one. But essentially, we're still in the same position. We've got a rapid narrowing of the range, the price range on a daily basis. So we've got a market very much in balance looking for a trigger. And there's the Australian dollar gold price. So turning to other commodities, copper was higher to 587, as we'll see in a minute with the chart. And crude oil has been bouncing around, took a big hit, was down about $15 when the ceasefire was announced. And since then, it's just been bouncing around in the mid-90s. But look, this ceasefire doesn't fix the crude position, crude supply position, or the liquid fuels mess that's being felt so severely in Australia, because there's a lot of infrastructure that has been destroyed and is going to have to be rebuilt. And particularly in LNG, where the Qatar facilities are going to take quite some time, possibly a couple of years, to get that back to full production. So higher prices for fuels, whether it be oil or jet fuel or petrol or diesel, they're going to be here for some time, and they could go a lot higher yet. So don't think that this ceasefire has really changed things. There's the spot copper chart. You can see over the last couple of weeks, we've had quite a nice rebound back towards $6. And that's the crude oil charts. Pretty bouncy over the last couple of weeks. So wrapping things up, for me, this is the most important word that's on the tip of my tongue every minute of every day. I'm on the hunt for stocks that are largely immune, not just from what's happening in the Middle East, but immune from the other things that we can't control. And AI and software is obviously one of the big ones. And the Middle East is not the only place where we've got geopolitical upheaval. It's just going on elsewhere to varying degrees. We've obviously got the energy crisis and how that will play out as a complete unknown. So in a situation where you've got a whole cupboard full of unknowns, why would you want to own stocks that are in an environment that is quite unpredictable and they're dragging this lead weight, this fear around with them, that no one's really going to support the price because they don't know what's going to happen? And there's more than enough others in the immune category that you just don't need to go outside it. That's the key point. You don't need to have a balanced portfolio. I mean, who says? A balanced portfolio is a good idea if you have no idea how to manage risk. So you just let the market carry on, diverge in whatever direction it wants to diverge in, and you end up with a very average result. That's pretty unsatisfying investing from my perspective. There are more than enough to get really targeted on just the high performers and also high probability performers. So for me, the classical diversification is just the lazy way to go about it. We manage risk by doing detailed research, make sure we're in the right pond. We get clear plans, clear and simple plans. And the new members that come into specialist share education, I think, get a little bit surprised about how simple the plan is that I'm getting at. And they often come back to me with quite detailed plans that have taken them maybe hours to think about when it could have been done in 10 minutes. It's very simple. It needs to be very simple because we can't stick to complex plans. We can't do it. I can't do it. So you've got to keep it really simple and then just have sensible weightings. Don't bet the farm on anything because of an opinion that you form. Just manage risk. Accept that nothing is guaranteed. So that's it for this week. I'll be back with you next Sunday, and I'm sure there'll be a great deal to talk about. Cheers.